What's up everyone, my name's Robbie, this is Robbie in Manila, and today we're talking about the best industrial sector ETFs. So this is the 8th video in our series about the best sector ETFs. Actually, is it the 8th video? I'm pretty sure it's the 8th video. I think it's the 8th video in our series. Of course, today we're talking about the best industrial sector ETFs. Now you might be asking yourself, why would you invest in a certain sector ETF? Of course, there's many different reasons why investors do this, but sometimes investors think a certain sector is going to do well for whatever reason. Could be undervalued, could have good charts or good technicals. There could be something interesting going on in the economy. There's just a lot of different reasons. So if you find yourself wanting to overweight an industrial sector ETF, this is what we're going to talk about today. So the next question is, how has the industrial sector in general done recently? So in this really cool graphic, we have the different sector returns of the S&P 500, and what you'll see is, first off, the S&P 500 return, which is this light gray box. And as you can see, year to date for 2021, it's returned 15.3% so far. Now we want to take a look today at the industrial sector and how this is performed. So year to date, the industrial sector has slightly outperformed the S&P 500 with a 16.4% year to date return. But as you can see, if you look back, sometimes this sector outperforms, sometimes it underperforms. For example, in 2020, it underperformed the market. In 2019, it underperformed the market. In 2018, it underperformed the market. But going back to 2016, it outperformed the market. So there are times when this sector will outperform and times when it won't. So as you can see, this year so far, if you had decided to go overweight industrials, it would have been a good idea. But over the past few years, it hasn't really outperformed. So if you had bought it a few years ago, it may not have worked out so well. Anyway, okay, let's go ahead. Let's get this thing started. Let's figure out what is the best industrial sector ETF. Let's get this thing started, and of course, in the comments below, please let me know, what do you think about industrials this year, 2022, coming up? Are you bullish on it? Are you bearish on it? Let me know. I'd love to hear from you in the comments below. So we're talking about 4 different ETFs in this video. We're going to find out which of these 4 are the best industrial sector ETF. The first one we're going to go over today is the Fidelity MSCI Industrial Index ETF. It's FIDU is the ticker. Next we have the Vanguard Industrial Index Fund ETF. It's VIS. Then we have the Industrial Select Sector SPDR, XLI, and finally we have Invesco S&P 500 Equal Weight Industrials, RGI. Here we have our ETF comparison tool. As you can see, for example, here FIDU is this column, VIS is this column, XLI is this column, and RGI is this column. First thing I'm going to take a look at is the expense ratio. So our first ETF is FIDU with a 0.084% expense ratio, very cheap ETF. Then we have VIS, which is also very cheap at 0.10%. XLI, also very cheap at 0.12%. And then we have RGI, which is not as cheap at 0.40%. So once you get into this area, basically I ask a question, and that is, can RGI somehow prove to me that it deserves to be chosen over the cheaper ETFs? So we're going to figure that out, but next thing we're going to go and look at is how the ETFs are weighted. So what you'll see here is all of these ETFs, so FIDU is market cap weighted, VIS is market cap weighted, XLI is market cap weighted, and RGI is equally weighted. Now what does that mean? If you're not familiar with this, basically think about like if you had a portfolio and you had $1,000. And if you had 10 stocks in that portfolio and you had an equally weighted portfolio, every stock in that portfolio would be $100. Because you have 10 stocks and 10 stocks $100 each equals $1,000. But if you had a market cap weighted portfolio, instead of having them all being $100, it would be weighted based on the larger companies having more of the portfolio. So if you had like a Google or an Apple in there, maybe one of those would be $200 and the cheaper one would be $50. That's a market cap weighted portfolio versus equally weighted. Hopefully that makes sense. Next, let's take a look at the dividend yield. So first off, we have FIDU with a 1.08% yield. Now, it's not a high yield, so this wouldn't maybe be something you would buy just for yield. VIS is the same, 1.14, XLI 1.24, RGI 0.71. So they don't have high yields. Now, RGI does have quite a bit less yield than XLI, so the question is RGI outperforming on a rate of return perspective? So that's what we're going to take a look at. Next, I want to take a look at some of the fundamentals real quick just to see what's going on here. Price to earnings wise, they're all very similar. 24 is the lowest price to earnings. RGI is the highest price to earnings with 26.6. Price to book, they're all very close as well. The lowest being 4.4, highest being 5.1. So they're all very close fundamentally. Let's take a look at the Morningstar ratings now. So first off, the 5-year rating, FIDU has a 4-star, VIS, XLI have 3 stars, and RGI is a 4-star. Next we have FIDU and all the others with 3 stars except RGI, which has a 4-star. And then on the 10-year, we don't have enough info for FIDU, but RGI is outperforming on the 5-year as well. So basically, I'm looking at this and RGI actually has the best ratings out of these funds. Here we go, the meat and potatoes, the one that everyone wants to know, how are these performing versus each other? Let's first take a look at the 5-year return. FIDU, 15.42%, VIS, 14.96%, XLI, 14.96%, RGI, 17.88%. So RGI is outperforming by a significant amount. So is this just the 5-year? Let's take a look at the others. So for the 3-year, looks like RGI is also outperforming significantly. And on the 10-year, looks like RGI is also outperforming by over a percentage point over 10 years. So RGI is looking good. Now let's take a look at the portfolio real quick to see what's going on. So which of these are more diversified, which are more concentrated? FIDU is more diversified with 345 holdings. VIS more diversified. XLI and RGI are a bit more concentrated, but they still have 76 holdings, so they're not very concentrated, but just more concentrated relatively speaking. If we take a look at the top 10 holdings, Union Pacific Corp for FIDU, VIS as Union Pacific Corp, XLI as Union Pacific Corp, and then remember RGI is equally weighted, so it's going to have a bit different of a holding structure. And Old Dominion Freight, for example, is the highest weighted in this, but remember this will try to keep an equally weighted portfolio, so Old Dominion Freight likely has just had a really good maybe quarter or half year, and that's why it's kind of a higher weighting of the portfolio right now. So the other ones, we have UPS in here, Honeywell, Boeing, Caterpillar, so companies that you've heard of before, big giant industrial companies. Taking a look at the sizes of the companies based on market cap, we have no giant companies in this, so there are no giant companies in the industrial sector. Giant companies are 200 billion in market cap or higher, but we do have a lot of large cap. So XLI has the highest concentration in large. RGI has the smallest concentration in large. So RGI is way more positioned to have mid-cap companies in it, and that's probably why it's done better in this particular sector. Mid-cap companies, I'm guessing, have done a bit better than the larger companies. So here we go. What is the best industrial sector ETF? In my humble opinion, it's RGI. Now you might be shocked because RGI has a higher expense ratio, and to me, it's justified the expense. Now let's say that you're sensitive to expense ratios. Maybe you don't want to pay any more than like 0.15%. If you're not comfortable doing that, here's my backup ETF. So in this situation, I would go with FIDU because, well, it's the cheapest, but it also has the best returns after RGI. So a 5-year 15.42%, which has outperformed the other one. So basically, FIDU is my second ETF, the runner-up. So anyway, let's go ahead and take a look at RGI versus the S&P 500. So as we can see, the industrial sector actually has done a good job keeping up with the S&P 500. There are times when RGI is actually outperforming the S&P 500, and there are times where it's slightly underperforming. So honestly, sector seems pretty good to be in line with what's going on in the S&P 500 over the past 10 years, at least. All right, next thing I want to talk about are the technicals. So RGI was trading in an uptrend channel starting in around March of 2020, and it broke down through this channel in around mid-June of 2021. It seems to have traded sideways and consolidated, but around late October 2021, it did have a small breakout and was able to make it up to 200 where it was rejected. And now it's trading down in the 188 area. So what do I think of this? The first thing is I really like what's going on in RSI. RSI is showing an oversold signal. And when RSI is oversold, a lot of times, that means there will be an increase in the stock price. MACD hasn't started going closer to the signal line yet, but I think it's probably going to happen soon. And so what I would say is I like this basically set up in terms of indicators. what I might do is say, what's going to happen after this little candlestick? Does it go further and try to test 182? And if it does and it bounces, that could be a great time to buy. Alternatively, if it breaks above this 192, it could also be a good time. So that's all we have for this video. Thanks so much for watching. I hope you liked it. If you did, hit that like button, subscribe to see future content like this. And by the way, have another video. It's coming up in the end screen. You should definitely watch it, and it's coming up right now.